Howdy, everybody. Welcome, Liberty Call. Today is Wednesday, June 26, 2024. Hope you're having a fantastical day out there in the interwebs. It is a beautiful yet hot day here in Colorado, and I don't know when we're going to get some relief. Hopefully soon. So it has been, actually, I think next week it's supposed to cool off again. So anyways, hope you're having a fantastical day out there in the interwebs. Astros swept a second series. Granted, it was against the Rockies. It was only 2 games, but they won today's day game. So they have won, I think, like 8 in a row. It's unreal. They're back to 500. Break even. Only took them 80 games. All right. Well, I'm glad you're here. And if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell, because I say smart things once or twice a week. So you got to tune in every day, because today may not be the day. Could be. I don't know. I never know what I'm going to say until I say it. So, all right, let's jump in and get the markets for today. The Dow Jones was flat, up 0.04%, 15 points, closed at 39,127. The S&P 500 was up 0.16%, 8 points, closed at 54,77. NASDAQ up 0.48%, 85 points, closed at 17,802. The VIX was flat. It's at 1255. Canada up 0.02, Brazil up 0.29, and Mexico down 0.26. In Europe, Germany was down 0.08, UK down 0.27, France down 0.69%, the Netherlands down 0.38%, Spain down 0.8%, Italy down 0.49%, Switzerland down 0.62%, and Portugal down a third. None of these were down too bad, but just, in the red. Russian exchanges, both in the green today. MOEX up 1.18%, RTSI up 0.57%. And the overnights, the Nikkei in Japan was up 1.26%, Australia down 0.71%, New Zealand up 1.11%. In China, the Shanghai was up 0.76%, the Shenzhen Component up 1.55%, China A50 up 0.09%, DJ Shanghai up 0.88%, Hang Seng up 0.08%, and when the Taiwan weighted closed on the 25th, it was up 0.27%. All right. Exciting stuff, I know. Are you excited out there in internet land? I know I am. All right, let's get over to the market recap. S&P 500 wavers as Nvidia gives up its gains. All right, on Wednesday, U.S. stocks fluctuated as Nvidia's early gains were erased, dampening the broader tech sector's performance ahead of key inflation data. Nvidia fell over 1% after an initial rise following a significant 7% rally the previous day. Despite this, investor sentiment remains positive due to the company's AI-driven growth this year. The market is closely watching the upcoming monthly PCE price index, the Federal Reserve's preferred inflation gauge, due on Friday. This data is crucial as the Fed has projected only one interest rate cut in December. Now they're talking December. They were talking September last. These financial journalists cannot keep up with the script. Seriously, folks. Recent improvements in the Consumer Price Index and Producer Price Index have raised hopes for a cooler PCE, potentially signaling good news for policymakers. FedEx saw a significant 14% surge after the company projected full-year revenue growth in the low to mid-single digits and announced a $2.5 billion share buyback plan. Analysts had anticipated a 3% increase, and FedEx's results are often viewed as indicative of the global economy's health. Rivian Automotive jumped 20% following the announcement of a joint venture with Volkswagen, the German automaker investing an initial $1 billion in the electric vehicle maker. Yeah, they just set that money on fire. Nothing's ever good's going to come from that. Conversely, Southwest Airlines managed to mitigate most of its losses despite lowering its second quarter revenue forecast due to uneven travel demand. The airline now expects a 4 to 4.5% drop in operating revenue per available seat mile, worse than the previous forecast. General Mills dropped over 4% after the company forecasted lower than expected annual profit and reported a significant quarterly sales decline attributed to reduced demand for snack bars and pet food and higher input costs. Banking stocks were under scrutiny ahead of the Federal Reserve's annual stress test, which evaluates whether major U.S. banks can withstand economic shocks. We shall see. Energy stocks were the day's biggest losers as oil prices fell following unexpected increases in domestic crude and gasoline stockpiles, raising demand concerns. EQT Corporation, Hess, and Halliburton each fell around 2%. Overall, the mixed performance reflects investor caution as they await crucial inflation data that will influence the Federal Reserve's future monetary policy decisions. Yep, we're just waiting for the Fed to get off their ass and lower rates because that's going to solve all the world's problems. 0.25% going from 5.5 down to 5.25, or from 5.25 down to 5, that will solve all the world's problems. I didn't know if you knew that out there, but it will. I'm being sarcastic right now. See how I do that with such a straight face? It drives my wife crazy. All right, next up, some May new home sales data. Let's go ahead and dive into that. This comes from our friends over at First Trust, Mr. Bryce Gill. He's an economist there. He's the publisher of this article. In May, new home sales fell more than expected, marking the largest monthly decline since 2022 after consecutive gains. Sales have normalized to pre-COVID 2019 levels, hindered by persistent high inflation and delayed Federal Reserve rate cuts. They're not really delayed rate cuts. I mean, rates are pretty much at neutral, in my opinion. Keeping 30-year fixed rate mortgages above 7%. Oh my God, outrageous. This rate hike translates to a 24% increase in monthly payments for a median new home, assuming a 20% down payment. On the positive side, the median sales price of new homes dropped 9.3% from its peak in 2022, partly due to lower prices per square foot and an increase in the availability of lower-priced homes as developers adjust to market conditions. The supply of completed single-family homes has surged over 200% since its 2022 low, contributing to downward pressure on new home prices. In contrast, the existing home market struggles with limited inventory as current homeowners are reluctant to sell due to their low fixed rate mortgages secured during the pandemic. This disparity suggests that while a significant rebound in new home sales is unlikely, increased inventory offers potential buyers more options, stabilizing sales. The Federal Reserve's prolonged period of artificially low interest rates has led to buyer expectations of such rates as normal. They're not, causing sticker shock with current higher rates reflecting economic fundamentals. See, that time between like 2010 and about 2018, rates were like basically as low as you could get them. So anyone who bought a house during that time, me included, we got rates at under, around 3%, and then they got even lower after things fell apart in 2020 and 2021. Before they started raising interest rates, people were moving out of the cities into the suburbs and into the rural communities, which, if you locked it in at those, because I even looked at refinancing at the time, it didn't make sense because I was going to increase my mortgage balance by like $15,000. And I was like, I'm already paying extra on the mortgage. Well, me and my wife, we're already paying extra on the mortgage, and, we're probably going to pay it off, years early. So why would I do this and increase my balance just for my interest rate to go down? I don't know, it was maybe 1% at the time. So it didn't make a whole lot of sense. Alrighty. However, history shows that strong housing markets can exist with these rates, proving the job market remains robust and buyers adjust their expectations. Yeah, back when my parents moved into the house that my dad still lives in 1978, granted, this is, my little small sector of the world of Houston back when I was a little kid, but it was growing like crazy, and it just expanded and expanded and expanded during my school years. And, even since I've, joined the military, moved away, came back, lived a decade there, and then now have almost lived a decade here in Colorado. It is completely, there's nowhere else to build in Clear Lake where I grew up. Everyone has moved south across the creek into Galveston County. There's tons of room to expand out there. There's just nowhere to expand in the Harris County section of Clear Lake. So All right, diving back in. In other news, the Case-Shiller Index rose 0.3% in April, up 6.3% year over year, while the FHFA Index increased 0.2% in April, up 6.4% year over year. In manufacturing, the Richmond Fed Index fell to negative 10 in June from 0 in May, indicating a contraction in the Mid-Atlantic factory activity. Additionally, the Federal Reserve reported that the money supply rose 0.4% in May and 0.6% over the past year. After significant growth during the early COVID years, M2 is stabilized, potentially exerting downward pressure on nominal GDP growth. All right. Good stuff there. One last article, I read this last night, so I figured I'd share it with y'all today, is The Global Inflationary Depression Already Here? And this was written by Peter St. Onge and Jeffrey Tucker of the Brownstone Institute. All right. Mr. St. Onge and Jeffrey Tucker from the Brownstone Institute highlight the emerging crisis in the commercial real estate and its broader implications for urban development and national productivity. A New York Times article links the crisis to high interest rates, which complicate loan refinancing, and low office occupancy rates stemming from the pandemic-induced lockdowns. The authors argue that the lockdowns, a human decision rather than a necessity, disrupted economic data and caused volatility never seen before in industrial history. The high interest rates are an attempt to mitigate the inflation caused by the excessive money printing in March of 2020, when over $6 trillion was introduced into the economy, leading to persistent inflation. The Bureau of Labor Statistics is criticized for inadequately tracking inflation. Essential costs like interest, taxes, housing, health insurance, and more are not accurately reflected in the Consumer Price Index. Shadow Stats estimates inflation at double digits for the past 2 years, peaking at 17%, while the National Bureau of Economic Research estimates 2023 inflation at 19% when accounting for interest. Fast food prices, a reliable inflation measure, have increased faster than the official CPI by 25 to 50%. Inflation misreported affects all economic data. Retail sales, for instance, appear higher because consumers pay more for the same goods, not because they are buying more. And that's something I've been talking about a lot with my clients right now during meeting season here mid-year, is that, you know, and that's consumer spending has been the chart that, well, it's going this way if you're looking at me. So as the chart's going up, up, and up, I'm looking for spending to, flatten or, tip over. And, while, your box of Cheerios has gone from, like this down to this, but it's more expensive, it looks like spending is still increasing when in reality, I would argue that the cost per unit is cost per ounce or cost per weight or whatever it might be has actually gone up, kind of like your price per square foot in your house. It has gone up, even though, it looks like on paper, everyone is just buying more and more stuff. Where was I? The same applies to factory orders and other indicators. Adjusted for inflation, perceived economic growth evaporates, with real factory orders barely increasing since 2021. Employment data is also misleading, with double counting and inaccurate surveys distorting the picture. Worker participation rates and employment to population ratios have not returned to pre-lockdown levels. Yeah, the labor participation rate is sitting at 62.5. It was like 63.5 back in 2019. So where's that 1% of inflation or 1% of participation in the economy gone? Supposedly we've got all these illegal immigrants coming in and taking jobs. So, wouldn't they be counted in the participation? Granted, yes, we have the baby boomers who are, leaving the workforce in droves at this point, just because, the youngest boomers were born in 65 or 64. So they are turning 60 this year. So, like my dad, who was born in 1950, he's 74 right now. So he's already, he's not working anymore. He's got his little accounting business he does, on the side, but he's not, working a regular job anymore. So anyway, that's what I'm pointing to is like, hey, there's some things just aren't jiving here. The statistics, aren't adding up. Anyways, jumping back in, GDP calculations are flawed due to outdated methods that add government spending to GDP, thus masking the real economic situation. Like last fall, the third and fourth quarters, there was a ton of government spending in there, which made the GDP numbers look fantastic. It was like, well, look at this. The economy's great. It's like, well, yeah, but if you strip out all the bombs and missiles and all that all that government spending, the economy is just kind of meh. Adjusting for GDP for realistic inflation suggests the economy has not recovered since the recession that began in March of 2020. Household finance reflects the broader economic issues, with savings rates plummeting and credit card debt rising. The official data suggests that the dollar lost 23% of its purchasing power over the past 4 years, but real-world impacts are likely much higher, around 35 to 75%. The global nature of inflation and output declines points to a widespread economic issue, potentially an inflationary recession or high inflationary depression. Traditionally, economic models like the Phillips curve fail to explain the current situation, where both output and employment are distorted by government spending and debt. The commercial real estate crisis covered by the New York Times exemplifies the broader economic issues. Large banks' reluctance to comment on the crisis reflects a don't ask, don't tell economy, where admitting the truth about hyperinflation or economic depression is avoided. The authors conclude that the lockdowns were the turning point, setting off the current economic challenges. And personally, I think we are past the point of return of saving the republic, and we're $35 trillion in debt. And I just had a meeting with my dad and was going through the numbers as far as, at $35 trillion at a 4% interest rate, if we applied $2 trillion of tax revenue towards the debt, it would take like 15 years to pay it off. And that's not even paying any of the government bills, all the ridiculous jobs and federal employees that we got and all the stupid things that we spend money on. That's not even, we haven't even, to do that, you wouldn't, it's crazy. Anyways. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information there. If you need to get your financial crap together, get back on track so that you can actually not have to work the rest of your life, give me a buzz. Shoot me an email, drop me a phone call. Be happy to help you get your plans back on track. All right. Well, that's everything that I had for today. Like I said, I hope everyone has a wonderful evening out there in the interwebs, and I hope everyone has a good night. Talk to you next time. Adios.